Event report, surge in digital currency adoption predicted at Davos 2025. Date, January 24, 2025. Location, World Economic Forum Annual Meeting, Davos, Switzerland. Overview. During the World Economic Forum WEF Annual Meeting 2025, analysts projected a significant increase in global digital currency adoption rates, estimating that adoption could reach 25% by early 2026. This anticipated surge is expected to be driven by a combination of economic reforms discussed at the event, particularly those related to regulatory changes in the United States under a newly elected administration led by President Donald Trump. Key insights from WEF sessions. 1. Regulatory frameworks. One of the most discussed topics at the forum was the potential for new cryptocurrency regulations in the U.S. Brian Armstrong, CEO of Coinbase, emphasized the transformative impact these regulations could have. He noted that Trump's pro-crypto stance could establish a clear regulatory framework that fosters innovation and encourages greater adoption of digital currencies. Armstrong pointed out that effective regulations would need to balance consumer protection with the promotion of financial innovation. Lesetja, Kganyago, governor of the South African Reserve Bank, highlighted the challenges regulators face due to the rapidly evolving nature of cryptocurrencies. He noted that many policymakers are still grappling with understanding the complexities of the crypto landscape. 2. Economic context. The global economic outlook remains cautious, with the International Monetary Fund (IMF) projecting a growth rate of 3.3% in 2025, slightly below historical averages. Inflation rates are expected to decrease, potentially creating a more favorable environment for monetary policy adjustments that could indirectly promote cryptocurrency adoption. During the sessions, leaders stressed the need to identify new sources of economic growth amidst shifting global dynamics. The discussions focused on how digital currencies could serve as a catalyst for economic revitalization, particularly as new regulations take shape. 3. Technological advancements. Donnell Dixon, CEO of the Stellar Development Foundation, discussed the potential of blockchain technology to facilitate fast peer-to-peer transactions across borders. This capability could enhance financial inclusion, particularly in underserved regions. Armstrong echoed this sentiment, stating that many Fortune 500 companies are exploring crypto initiatives, indicating a growing acceptance of digital currencies in traditional business practices. Experts noted that the technology's ability to streamline transactions could revolutionize the financial landscape, providing opportunities for developing economies to participate more fully in the global economy. 4. Future projections. Analysts indicated that U.S. regulatory clarity could prompt other G20 nations to follow suit, creating a more conducive environment for digital currency adoption worldwide. The timeline for these developments may see new regulations rolled out before the end of the U.S. congressional term in early 2027. The overall sentiment is that if the U.S. establishes a clear regulatory framework for cryptocurrencies, it could pave the way for broader acceptance and usage across the globe, with projections suggesting that digital currency adoption could mirror the early days of the Internet. Common themes and differences. Across various discussions, there was a consensus on the significance of upcoming U.S. regulatory changes, which many believe will act as a catalyst for wider digital currency adoption. However, opinions varied on the pace of adoption and the immediate implications for global economies. While some experts expressed optimism about rapid advancements, others cautioned that existing misconceptions and regulatory hurdles could slow progress. Conclusion. The discussions at Davos 2025 indicate that a combination of favorable economic conditions, technological advancements, and proactive regulatory measures could lead to substantial growth in digital currency adoption by early 2026. As stakeholders navigate these changes, the importance of clear regulations cannot be overstated. They will be crucial in driving both innovation and consumer trust in digital currencies. The anticipated regulatory landscape driven by the U.S. administration's approach will likely influence global trends shaping the future of finance and potentially transforming the global economic landscape in the years to come. The content contains several counterintuitive insights regarding the projected surge in digital currency adoption, particularly in the context of regulatory frameworks and economic conditions. 1. Pro-crypto regulation versus consumer protection. It may seem counterintuitive that stricter regulations can lead to increased adoption of digital currencies. However, experts argue that clear and effective regulations can provide the necessary framework for consumer protection while also fostering innovation. This challenges the common perception that regulations inherently stifle technological advancement. 2. U.S. regulatory influence on global trends. The expectation that U.S. regulatory changes will prompt other G20 nations to adopt similar measures is surprising. Many may assume that regulatory changes in a single country would have limited influence internationally, especially given the diverse regulatory environments across nations. Yet analysts believe that a proactive U.S. stance could create a ripple effect encouraging global adoption of digital currencies. 3. Economic growth despite strain. The projected global economic growth rate of 3.3% in 2025, which is below historical averages, might suggest a pessimistic outlook. However, the anticipated decline in inflation rates is positioned as a catalyst for monetary policy adjustments that could ultimately benefit digital currency adoption. This perspective flips the narrative that economic stagnation is solely detrimental, highlighting instead potential opportunities for innovation. 4. Consumer misunderstanding of digital currencies. Donnell Dixon's assertion that cryptocurrency is widely misunderstood points to a paradox. The more innovative and transformative the technology, the more likely it is to face skepticism and resistance from consumers and regulators alike. This contrasts with the narrative that greater technological sophistication automatically leads to broader understanding and acceptance. 5. The role of blockchain in financial inclusion. The idea that blockchain technology can enhance financial inclusion, especially in underserved regions, may seem optimistic given the historical barriers to access in these areas. Yet experts argue that the rapid peer-to-peer transaction capabilities of blockchain could significantly improve access to financial services, challenging the notion that traditional banking systems are the only viable means for financial inclusion. 6. Adoption curves similar to the Internet. The comparison of crypto adoption to the early days of the Internet presents a paradox. Many people assume that technological advancements would lead to faster adoption rates due to increased awareness and education. However, the experts predict a gradual uptake, suggesting that, like the Internet, cryptocurrency will require time for consumers to understand its value and practicality. 7. Investment in infrastructure versus regulation. There's a counterintuitive relationship between the need for robust infrastructure and the establishment of regulatory frameworks. While one might expect that regulatory clarity would come after infrastructure is built, the discussions suggest that regulatory clarity is necessary to attract investment in the infrastructure that supports digital currencies. This highlights the complex interdependencies between regulation and technological development. 8. Implications of automation and smart contracts. The potential for smart contracts to revolutionize transaction settlements is framed as both a threat and an opportunity. While the efficiency gained from automation could disrupt traditional financial models, it also suggests a shift in how financial transactions are perceived and executed. This duality challenges the assumption that innovation will always be embraced unconditionally. 9. Expectations of economic growth versus quality. The focus on the difference between quantity and quality of growth challenges the traditional metrics of economic success. While many associate GDP growth with positive outcomes, there's a growing recognition that the nature of that growth, whether it is inclusive, sustainable, and equitable, is equally, if not more, important. This redefines the benchmarks for success in economic discussions. These counterintuitive insights suggest that the path to increased digital currency adoption is fraught with complexities that challenge conventional wisdom about regulation, economic growth, and technological acceptance. The report's projections for increased digital currency adoption, particularly the anticipated 25% global adoption rate by early 2026, are significant in several ways that many might overlook. 1. Regulatory frameworks and political influence. The potential influence of U.S. regulatory changes under President Donald Trump is a critical factor. Trump's pro-crypto approach could lead to a ripple effect, encouraging other countries to adopt similar regulatory frameworks. This is significant because it emphasizes the role of political leadership in shaping economic landscapes. The fact that a major economy like the US is potentially moving towards favorable crypto regulations could create a more stable environment for digital currencies, which in turn may foster innovation and attract investment. The mention of a new cryptocurrency launched by Trump himself adds a layer of political branding to digital currencies, which could further legitimize them in the eyes of the public and investors. 2. Economic context of adoption. The economic backdrop, with global growth projected at 3.3% and declining inflation rates, indicates a potential for a favorable monetary policy environment. This context is often overlooked. It suggests that as economies stabilize, individuals and businesses might be more inclined to explore alternative financial systems such as cryptocurrencies. In particular, lower inflation could reduce the appeal of traditional fiat currencies, making digital currencies more attractive as a hedge against inflationary pressures. 3. Technological advancements and financial inclusion. The transformative potential of blockchain technology is highlighted, particularly its role in enhancing financial inclusion. Many discussions around digital currencies often focus on their speculative nature, overlooking how they can provide access to financial services for unbanked populations. For instance, the ability to facilitate rapid borderless transactions can empower individuals in underserved regions, thereby promoting economic development. The report includes examples of how entities like the UNHCR are already utilizing blockchain for efficient aid delivery, showcasing real-world applications that can significantly impact lives. 4. Business adoption and integration. The report notes that many Fortune 500 companies are piloting crypto initiatives, signaling a shift in corporate attitudes towards digital currencies. This trend is crucial as it reflects a growing acceptance of cryptocurrencies within established business practices, which could lead to mainstream adoption. The integration of crypto into traditional business models could also influence consumer perceptions, making digital currencies more familiar and acceptable. 5. The importance of clarity in regulations. The emphasis on the need for clear, consumer-friendly regulations is often understated. The complexity and rapid evolution of the crypto landscape present challenges for regulators, but clarity could facilitate broader adoption by providing consumers with the confidence to engage with digital currencies. The discussion around balancing innovation and consumer protection is vital, as it addresses a key barrier to adoption. If regulations are perceived as too restrictive or unclear, they may stifle innovation and dissuade potential users. 6. Global ripple effects and G20 dynamics. The likelihood that U.S. regulatory clarity could lead to similar actions by other G20 nations is significant. This interconnectedness highlights the global nature of cryptocurrency markets and the potential for a coordinated approach to regulation. If major economies align on regulatory frameworks, it could create a robust ecosystem for digital currencies, enhancing their legitimacy and stability. 7. Misunderstandings and consumer education. Experts pointed out that the general public often misunderstands cryptocurrencies, focusing on volatility and negative press rather than their utility. This misunderstanding can hinder mass adoption. The significance here lies in the need for educational initiatives that demystify cryptocurrencies and articulate their benefits clearly. As more people understand the practical applications of digital currencies, adoption rates are likely to increase. 8. Long-term implications for economic structures. The discussions at Davos suggest that digital currencies may not just be a passing trend but could reshape financial systems globally. The potential for cryptocurrencies to facilitate instantaneous transactions, reduce costs, and improve efficiencies in financial services could lead to broader structural changes. This has implications for how economies function, particularly in terms of monetary policy and financial inclusion. In conclusion, while the projections for digital currency adoption are noteworthy, the underlying factors influencing these trends are equally important. The interplay of regulatory developments, economic conditions, technological advancements, and public perception will shape the future of digital currencies in ways that merit deeper consideration. Understanding these dynamics can provide a more comprehensive view of the potential impact of digital currencies on the global financial landscape. 1. Regulatory frameworks and their impact on adoption. Analysts underline the critical importance of regulatory clarity in driving digital currency adoption. The anticipated pro-crypto regulations from the U.S. administration, particularly under President Donald Trump, are seen as a catalyst for innovation and broader acceptance. Experts emphasize the need for regulations that protect consumers while fostering innovation. The challenge lies in the regulators' understanding of the rapidly evolving crypto landscape, as highlighted by global financial leaders at Davos. This regulatory framework may not only influence the U.S. market but could set a precedent for other G20 nations, potentially leading to a unified global approach to cryptocurrency regulation. 2. Economic context and growth prospects. The global economic landscape plays a significant role in the anticipated surge in digital currency adoption. With projected growth at 3.3% for 2025 and declining inflation, analysts suggest a favorable environment for monetary policy adjustments. This backdrop may create the conditions necessary for cryptocurrencies to gain traction as alternatives to traditional financial systems, particularly if the U.S. successfully implements supportive measures. The emphasis on identifying new growth sources at the World Economic Forum reflects broader economic strategies aimed at revitalizing economies, which could include digital currencies as part of the solution. 3. Technological advancements and financial inclusion. The potential of blockchain technology to facilitate rapid, borderless transactions is a key point of discussion among experts. This technology not only enhances financial efficiency but also promotes financial inclusion in underserved regions. The innovations led by major companies and the exploration of crypto initiatives signify a shift in traditional business practices. The ability of blockchain to enable instantaneous transactions and reduce costs presents a transformative opportunity for economies, particularly in improving access to financial services for marginalized populations and creating a more egalitarian financial landscape. For future projections and global trends, the consensus among analysts is that clear regulatory frameworks will lead to accelerated adoption rates of digital currencies, potentially reaching 25% by early 2026. This growth trajectory is compared to the early days of the Internet, with expectations for significant advancements in user experience and infrastructure. The discussion at Davos reflects a broader recognition that cryptocurrencies can play a vital role in shaping the global financial system, fostering economic freedom and lifting millions out of poverty. The interaction between regulatory clarity, technological progress, and economic conditions will ultimately determine the pace at which digital currencies become mainstream. In conclusion, the discussions and insights from Davos 2025 highlight the intertwined nature of regulation, economic conditions, technology, and future projections in shaping the landscape for digital currency adoption. Each of these points warrants in-depth analysis to understand their implications not only for the financial sector but also for global economic dynamics. 1. The introduction of the 1999 to 2002 euro. The euro was introduced as a digital currency for transactions among member states of the European Union. It aimed to facilitate trade and economic cooperation by eliminating currency exchange issues. The launch of the euro was a significant moment in financial history, leading to increased economic integration among European nations. Similar to the current projections for digital currency adoption, the euro's introduction was driven by the need for a unified economic approach, regulatory frameworks, and political backing, which in this case included the support of European leaders and institutions. 2. The dot-com boom 1990s-2000. The late 1990s saw a significant surge in internet usage and digital commerce, leading to the dot-com boom. This period was characterized by rapid technological advancements and the establishment of numerous internet-based companies. Analysts at the time predicted that the internet would revolutionize commerce and communication, similar to the anticipated impact of digital currencies today. The boom was fueled by favorable economic conditions, venture capital investment, and a regulatory environment that encouraged innovation in technology. However, the subsequent crash highlighted the risks associated with rapid adoption without adequate regulatory oversight. 3. The gold standard to fiat currency transition 20th century. The transition from the gold standard to fiat currency in the 20th century marked a significant shift in the financial landscape. This change involved governments moving away from fixed exchange rates tied to gold, allowing for greater flexibility in monetary policy. The move was influenced by economic crises, the need for more responsive monetary systems, and the desire for governments to exert more control over their economies. Similar to the current discussions around digital currencies, this transition required new regulatory frameworks and adaptations in global trade practices, illustrating how economic reforms can reshape currency systems and adoption rates. Analysts predict a significant surge in the adoption of digital currencies globally, projecting that by early 2026, approximately 25% of the world's population will be utilizing some form of digital currency. This anticipated growth is largely influenced by the economic reforms slated to be discussed during the World Economic Forum (WEF) annual meeting in Davos in 2025, particularly with the backdrop of a potentially new regulatory landscape under a Republican administration led by President Donald Trump. Key factors influencing digital currency adoption. 1. Regulatory frameworks. The U.S. is expected to introduce new cryptocurrency regulations aimed at fostering innovation while ensuring consumer protection. Brian Armstrong, CEO of Coinbase, highlighted that a clear regulatory environment could stimulate significant advancements in the crypto space. This shift may encourage other countries, particularly within the G20, to adopt similar frameworks, creating a domino effect in regulatory clarity worldwide. 2. Economic conditions. The global economy is projected to grow at a modest rate of 3.3% in 2025. With cooling inflation rates providing a more favorable environment for monetary policy changes that could benefit cryptocurrency utilization. As inflation declines, central banks may have more leeway to integrate digital currencies into their broader financial systems, potentially normalizing their use. 3. Technological advancements. The rapid evolution of blockchain technology is another critical factor. Experts assert that blockchain can facilitate faster and more efficient transactions, particularly in underserved regions. Donnell Dixon of the Stellar Development Foundation emphasized the technology's ability to enhance financial inclusion, enabling peer-to-peer transactions across borders. As corporations increasingly experiment with crypto initiatives, acceptance within traditional business practices is gaining momentum. 4. Cultural shifts. There is a growing recognition of digital currency's utility beyond speculation, especially among younger generations who are more comfortable with technology. The integration of digital currencies into daily financial transactions could mirror the early adoption phases of the Internet, gradually leading to mainstream acceptance. Future projections and implications. Regulatory momentum. Should the U.S. successfully implement favorable cryptocurrency regulations before the end of the congressional term in early 2027, it could significantly bolster digital currency adoption. Other nations might follow suit, leading to a more synchronized global approach to cryptocurrency regulation. Impact on traditional financial systems. The proliferation of digital currencies could challenge traditional banking models. Innovations such as blockchain may streamline processes like transaction settlements, potentially reducing reliance on banks as intermediaries. This evolution could reshape the financial services landscape, prompting banks to adapt or risk obsolescence. Financial inclusion. Digital currencies have the potential to uplift millions by providing access to financial services for unbanked populations. As blockchain technology democratizes access to financial systems, it could enhance economic opportunities in developing regions, contributing to global economic growth. Challenges ahead. Despite the optimistic outlook, hurdles remain. Misunderstandings surrounding cryptocurrency, coupled with existing regulatory hurdles, may slow down adoption rates. Education and clarity in the utility of digital currencies will be crucial in overcoming these challenges. Conclusion. The future of digital currency adoption appears promising, with a confluence of regulatory advancements, economic conditions, and technological innovations poised to drive growth. As stakeholders navigate the evolving landscape, the emphasis on clear regulations and consumer trust will be paramount. If these factors align favorably, we could witness a transformative shift in the global financial system, characterized by a substantial increase in digital currency utilization by early 2026. The upcoming discussions at Davos 2025 will be pivotal in shaping this trajectory, with implications that extend far beyond finance into the broader socio-economic fabric of nations.